Wealth is not merely accumulated, it is engineered. The most formidable fortunes in human history do not stem from the simple exchange of goods, but from the architectural manipulation of risk and sovereignty. To understand the apex of financial power, one must look past the modern conglomerates and examine the original machine that successfully merged the ruthless calculus of commerce with the absolute authority of the state. That machine was the Dutch East India Company. Chartered in the year 1602, it was not merely a fleet of ships chasing exotic spices across dangerous oceans. It was an unprecedented legal and financial leviathan designed to solve the fatal constraints of early global trade. The oceans were a graveyard for capital, where a single storm could obliterate a family fortune and send a prominent merchant to debtor's prison. Arcane prosperity treats this entity as the ultimate systemic prototype. We must view the VOC rather as a geopolitical weapon of mass financial expansion than a simple historical curiosity. By fundamentally rewriting the rules of ownership and liability, the architects in Amsterdam constructed a framework that allowed capital to transcend the fragile limitations of individual human lifespans and personal financial ruin. The core friction of the era was the binary nature of maritime expeditions. A voyage to the Spice Islands required immense upfront capital to build ships, hire mercenaries, and provision crews for years at sea. If the fleet returned, the profits were astronomical, often exceeding 400%. But if the fleet sank or fell to pirates, the financial destruction was absolute and inescapable. This dynamic created a psychological barrier to scale. The fear of total ruin kept capital fragmented and cautious. Wealthy individuals would only risk a fraction of their net worth on any single voyage, severely limiting the size and scope of the expeditions. The human mind is naturally averse to asymmetric downside, and this inherent conservatism starved the global market of the liquidity required to build a true empire. The solution was a masterpiece of financial engineering, the joint stock model. The Dutch East India Company divided ownership into public shares, socializing catastrophic maritime risk while simultaneously concentrating capital into a massive, centralized pool. This birthed the modern secondary market. On the erupting Amsterdam Stock Exchange, citizens traded highly liquid claims on perpetual profits, entirely divorced from the physical reality of scurvy and naval warfare occurring half a world away. Yet the true alchemy of the VOC was the invention of limited liability. For the first time, an investor's potential loss was strictly capped at their initial contribution. Prior to this, corporate failure meant generational ruin. By severing the chain between business collapse and personal destruction, this mathematical asymmetry reprogrammed human behavior. It transformed greed into a systemic engine, expanding risk appetite exponentially as retail investors poured in their savings, entirely insulated from the enterprise's moral and physical costs. Armed with this endless reservoir of public capital, the Dutch government granted the VOC sovereign powers. The company could legally wage war, negotiate treaties, strike coins, execute prisoners, and establish colonies. Fusing state power with private capital, the VOC became a terrifyingly efficient monopoly generator. It didn't compete in the free market. It conquered it, violently expelling Portuguese and British rivals from the Indonesian archipelago to secure absolute control over the global supply of nutmeg, mace, and cloves. Military conquest became a standard operating expense. Fortresses and warships were classified as capital expenditures required to protect the dividend yield. It was a closed loop. Retail capital funded a private military, which secured the monopolies required to pay back those same investors. Meanwhile, retail shareholders operated under an illusion of control. True power was fiercely guarded by the board of directors, the Heren 17th, or Lord 17. They weaponized information asymmetry, possessing advanced knowledge of returning fleets, shipwrecks, and military victories months before the public. Trading on this insider knowledge, they manipulated share prices on the Amsterdam Exchange, enriching themselves at the public's expense. The architects always extract the premium. This dynamic sustained the company through its golden age in the 17th century. The VOC became the wealthiest private entity in human history, employing tens of thousands of workers and commanding a fleet that rivaled the navies of sovereign European nations. It built a sprawling intercontinental supply chain that moved silver from Japan, textiles from India, and spices to Europe, optimizing global arbitrage on a scale never before witnessed. However, the very mechanics that enabled this explosive growth eventually triggered its slow, agonizing decay. The massive overhead required to maintain a private, intercontinental empire demanded constant, aggressive expansion. Fortresses require garrisons, warships require constant repair, and colonial administrators demand exorbitant salaries. The operational friction of running a sovereign state began to consume the profit margins of the spice trade. To sustain the illusion of infinite prosperity, the VOC engaged in a fatal financial maneuver. When operational profits fell short of the expectations set by the market, the directors began paying the annual dividends from borrowed capital rather than actual revenue. They issued corporate bonds to maintain the dividend yield, prioritizing short-term shareholder appeasement over the long-term structural integrity of the balance sheet. The normalcy bias of the market allowed this deception to persist for decades. Investors had grown so accustomed to the reliable payouts of the VOC that they rarely questioned the mechanics behind them. They trusted the historical momentum of the brand, ignoring the escalating debt load. The psychological comfort of a consistent dividend blinded the public to the reality that they were being paid with their own borrowed future. This is the inevitable collision between geometric debt growth and linear revenue generation. The architectural integrity of the corporation, fractured as the cost of servicing the debt eclipsed the income generated by the crumbling monopolies. The VOC transformed from an engine of capital creation into a zombie corporation, surviving solely on the inertia of its past glory and the continuous issuance of new debt to cover the old. The final catalyst for collapse arrived with the Fourth Anglo-Dutch War in the late 18th century. The conflict devastated the company's fleets and severed its vital trade routes. Deprived of its cash flow, the sovereign corporation could no longer service its massive debt obligations. The invincible Leviathan that had dictated global trade for nearly 2 centuries was suddenly exposed as a hollow, over-leveraged shell, incapable of defending its own borders. The resolution of this collapse perfectly encapsulates the ultimate privilege of the systemic architect. In 1799, the Dutch East India Company was formally dissolved, and its astronomical debts were nationalized by the Dutch government. The state absorbed the toxic liabilities, socializing the ultimate failure, just as the company had socialized its initial risk. The taxpayers were left to foot the bill for a century of corporate mismanagement. Yet, the blueprint survived the destruction of the vessel. The mechanics forged in Amsterdam, limited liability, public equity, corporate personhood, and the separation of ownership from management were permanently embedded into the global financial architecture. The VOC proved that a legally constructed entity could outlive its founders, transcend borders, and accumulate power that rivaled the state itself. It was the proof of concept for modern multinational capitalism. Every modern conglomerate, every sovereign wealth fund, and every highly leveraged private equity firm operates on the foundation laid by the Lord 17 in 1602. The separation of moral consequence from financial return remains the beating heart of the system. The ability to cap downside risk while socializing the costs of expansion is not a flaw in the market. It is the exact feature that the architects designed. The modern retail investor still falls into the same psychological traps that ensnared the citizens of Amsterdam. They still chase the illusion of ownership, trusting in dividend yields and corporate narratives while remaining completely disconnected from the boardroom machinations that dictate the true flow of capital. The asymmetry of information and power has not vanished. It has simply been digitized and hidden behind more complex layers of financial abstraction. To master wealth today is to understand this enduring legacy. The game has not changed in over 400 years. Only the speed of the transactions and the names of the empires have evolved. By studying the architectural mechanics of the first corporate Leviathan, one gains the ability to see through the modern illusions of the market. True prosperity belongs to those who understand the machinery, not just the output.